The Dow Jones Industrial Average (DJIA) is one of the most well-known stock market indices in the United States. It serves as a key indicator of the overall health of the U.S. economy and stock market. Here's how it works. 1. What is the DJIA? Composition: the DJIA is composed of 30 large, publicly traded companies in the United States. These companies are leaders in their respective industries and are meant to represent a broad spectrum of the American economy. Examples include companies like Apple, Coca-Cola, and Goldman Sachs. Price-weighted index. Unlike some other indices, the DJIA is price-weighted. This means that companies with higher stock prices have a greater influence on the index's movements. It's not based on market capitalization, the total market value of a company's outstanding shares. 2. How is it calculated? Price addition: the stock prices of all 30 companies are added together. Divisor: the sum is then divided by a divisor, which adjusts for events like stock splits or changes in the companies that make up the index. This divisor ensures that such events do not distort the DJIS value. 3. Role in the economy, economic indicator. The DJIA is often used as a barometer for the overall performance of the U.S. stock market and, by extension, the U.S. economy. When the DJIA rises, it generally indicates that investors are optimistic about the economy's future. Conversely, when it falls, it suggests economic pessimism. Investor sentiment: movements in the DJIA can influence investor confidence and behavior. A strong DJIA may encourage more investment, while a declining DJIA might lead to caution or selling. Media and public focus: the DJIA is widely reported in the media and is often the first reference point for understanding how the stock market is performing on any given day. 4. Limitations: narrow representation. Although the DJIA includes 30 major companies, it only represents a small fraction of the thousands of publicly traded companies in the U.S. economy. This can sometimes make it a less comprehensive indicator compared to broader indices like the S&P 500. Price weighting: since the DJIA is price-weighted, a stock with a higher price can disproportionately impact the index regardless of the company's overall size or market value. In summary, the DJIA provides a snapshot of the market's overall health and investor sentiment, making it a valuable, though somewhat limited, tool for gauging the U.S. economy. The stock market carries varying levels of risk depending on the type of investments, the investor's approach, and market conditions. Here are some factors that contribute to the risk level. Market volatility. Stock prices can fluctuate widely due to economic changes, political events, company performance, and investor sentiment. High volatility can lead to significant gains or losses in a short period. Company-specific risk. Individual stocks can be risky because a company's fortunes can change due to factors like poor management, regulatory issues, or competition. Investing in a single company can result in significant losses if that company underperforms. Economic and political risks. Macroeconomic factors such as inflation, interest rates, and geopolitical events can impact the overall market. Economic downturns, wars, or trade disputes can lead to market declines. Liquidity risk. In some cases, it may be difficult to sell an asset quickly without affecting its price. This is more common with smaller or less traded stocks. Time horizon. The risk associated with the stock market is generally higher in the short term. Over longer periods, the market tends to recover from downturns, so a longer time horizon can mitigate some risks. Diversification. By spreading investments across various sectors, industries, and asset types, investors can reduce the risk of significant losses. However, diversification doesn't eliminate risk entirely. Behavioral risk. Investor behavior, such as panic selling during market downturns or overconfidence during bull markets, can amplify risks and lead to poor investment decisions. While the stock market can offer high returns, it also carries significant risks, especially in the short term. Investors should consider their risk tolerance, investment goals, and time horizon when investing in stocks. Diversification, research, and a long-term perspective can help manage some of these risks. A good return on investment ROI can vary depending on the type of investment, the time horizon, and the level of risk involved. However, here are some general guidelines. Stock market. Historically, the average annual return on the U.S. stock market, for example, S&P 500, has been about 7 to 10% after adjusting for inflation. A return in this range is considered good for long-term investments. Real estate. For real estate, a good ROI is often around 8 to 12% per year, though this can vary widely based on location, property type, and market conditions. Bonds. For government or corporate bonds, a good return might be in the range of 3 to 5% depending on the bond's risk and duration. High-risk investments, investments in startups, cryptocurrencies, or emerging markets can potentially yield higher returns, sometimes exceeding 20% or more, but they also come with a much higher level of risk. Business investments. For private businesses, a good ROI might be 15 to 25% or more, depending on the industry and the business model. Low-risk investments. For low-risk investments like savings accounts or money market funds, a good return might be in the range of 1 to 3%, though these are generally used to preserve capital rather than generate high returns. A good return ultimately depends on your personal financial goals, risk tolerance, and the time you are willing to keep your money invested. Higher returns often come with higher risks, so it's important to find a balance that fits your individual circumstances.